Hi everyone, in this video we'll be going over A-Level Accounting 2023, May-June, Paper 2-3, question number 4. This is Paper 2, which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks. And the total time limit for this paper is 1 hour and 45 minutes. And since question number 4 is of 30 marks, ideally you should be spending about 35 minutes in order to complete this question. And in this video as well, we will be attempting to solve this question under 35 minutes. So without any further delay, let's get started. V Limited is a manufacturing company which uses marginal costing. Now for the first part of this question, we need to define the following terms. The first one is marginal cost. So marginal cost is just the costs incurred when producing one additional unit. Costs incurred when producing one additional unit. This is why everything is on a per unit basis for marginal costing. Now we need to define contribution. Contribution is the difference between selling price and variable costs. The difference between selling price and variable costs. And this difference will help cover our fixed costs, because remember, in our format we subtract our fixed costs from the contribution in order to figure out the profit or loss. So you can write that down as well, which helps cover fixed costs. Then the third one is break-even point. So break-even point is actually the level of output at which there is neither a profit nor a loss. Let's write it down. The level of output at which there is neither a profit nor a loss. That's all for the first part of this question. Let's move towards the second one. We're given additional information. The following information is available for a single type of product made at one of the company's factories. We're given the per unit selling price, direct materials and direct labor, and we're given the fixed cost per month. Now the maximum output per month is 2500 units and the factory operates at full capacity. So 2500 units is our full capacity. Now for the second part, we need to calculate the break-even point in units. So the formula for break-even point in units is just fixed cost divided by contribution per unit. So we're given the total fixed cost per month to be 36,900. Now the contribution per unit is just going to be our selling price minus the variable cost, which in this case is 52 minus 16 minus 18. This gives the contribution per unit to be 18. So that's 36,900 divided by 18, which results in 2,050 units. That's our break-even point in units. Now for the second part, we need to figure out the break-even point in sales value. So this is just going to be break-even point in units multiplied by the selling price per unit. So that's 2,050 multiplied by the selling price, which is given to be 52. And this gives the break-even point in sales value to be 106,600. Alright, now we're again given additional information. The directors plan to increase factory capacity to meet increased demand, and the following details are available. So the factory capacity will be increased by 15%. So previously our factory capacity was 2500. Now we just need to increase it by 15%. So that is just going to be 2500 multiplied by 1 plus 15%. And this results in our new level of output, or the number of output, to be 2,875. Then additional machinery will be required at a cost of 72,000, and the machinery is depreciated at 20% per annum on cost. Remember that we are utilizing our marginal costing per month, so we need to figure out the depreciation per month as well. So we start with a cost of 72,000. We multiply it by our rate, which is 20%, but this is the rate per annum, right? This gives the depreciation for 12 months. Now we just need to divide it by 12 in order to figure out our depreciation per month. And this gives the value to be 1200. This will be added to our fixed cost. So I'm just going to calculate the fixed cost right here. We start with the previous amount of 36,900. Then we add our depreciation per month of 1200. Alright, now the directors will apply for a bank loan of 60,000 at 8% per annum interest to finance the cost of additional machinery. Again, we need to figure out the interest per month. We start with the loan amount of 60,000. We multiply it by the rate of interest per annum, which is 8%, and this will give our interest for 12 months. So we just need to divide it by 12 in order to figure out the interest per month, which is 400. Again, we need to add it to our fixed cost. Okay, now the direct materials will cost less per unit as a result of buying in greater bulk. Suppliers currently give a 20% trade discount, but will give a 25% trade discount in the future. So we currently have 20% trade discount, which means that we only actually pay 80% of the cost. So this rate of 16 for direct materials is actually 80%. And now we're also told that we'll be getting a trade discount of 25%, which means that we'll only be paying for 75% of cost. So we need to figure out that 75%. So we already know that 80% of cost is 16, which will mean that 1% of the cost will be equal to 16 by 80. And we now actually require 75% of the cost. So that is just going to be 16 divided by 80 multiplied by 75, which results in the value of 15. So our new direct materials will be 15 per unit. Okay. Direct materials is going to be 15 now. And direct labor cost in the selling price will remain unchanged. Alright. For the third part, we need to calculate the increase in the monthly margin of safety in units, assuming all production is sold. So we first need to figure out our current margin of safety. And the formula for margin of safety is just going to be the maximum output subtract break-even point in units. So in the previous part, we are given the maximum output to be 2500, and we also calculated the break-even point to be 2050. So our previous or current margin of safety would be 2500 minus 2050, which results in 450 units. Now we need to figure out the margin of safety after these changes. Okay, and in order to figure out margin of safety, we first require break-even point. So let's calculate the new break-even point. The formula is just the fixed cost divided by contribution per unit. And we have already calculated the total fixed cost as well. That will be 36,900 plus 1200 plus 400, which results in 38,500. This will be our new fixed cost. Now, our contribution also changes because we have a change in our direct material. So the new contribution per unit is just going to be the selling price, that's not going to change, minus the direct material 15 and minus the direct labor 18. So this gives a new contribution per unit to be 19. Okay, this means that our new break-even point is going to be 2026.31, and we need to round it off. So that is going to be 2027 units. Now we need to figure out new margin of safety. Again, that is just going to be the difference between our maximum output and the break-even point. And in this case, our maximum output changes because our factory capacity will be increased by 15%. So the new maximum output is 2875 minus our new break-even point of 2027. And this gives our new margin of safety to have the value of 848 units. So we can clearly see that there is an increase. And this increase is just going to be the difference. So that's 848 minus 450, which is 398 units. That's the increase in margin of safety. That's all for the third part of this question. Let's move towards the fourth one. We're given additional information. V Limited produces a different single type of product at another factory. We're given the details. So we're given selling price per unit, contribution per unit, fixed cost per month, factory capacity per month. And currently the factory is operating at 85% capacity. So let's figure out the current number of units. That is just going to be 85% of 18,000. So that's 18,000 multiplied by 85%, which is 15,300. and all products are sold to regular customers. Now, the directors are considering accepting an order from a new customer, and the following details are available. First of all, let's have a look at our question. We need to calculate the profit per month to be made under each option. All right, let's have a look at the first one. Okay, the first one is to reject the order from the new customer. So let's have a look at this information first. The directors are considering accepting an order from a new customer, and the order is for 4200 units per month. That's the number of units. The customer is considering making a regular order for this quantity, so this order will be repeated in the future as well. The customer wishes the product to be packaged differently. This will add 0.50 per unit to variable cost. So first we need to figure out our previous variable cost. Remember, the formula for contribution is selling price minus variable cost. Contribution in this case is 8 and selling price is 26. So 8 equals to 26 minus variable cost, which gives our variable cost to be 26 minus 8, which is 18. Now for our new customer, additional 0.50 per unit is added to the variable cost. So that's 18 plus 0.5, which results in 18.5. And will require investment in new machinery, adding 1000 per month to fixed cost. So our new fixed cost will be the previous amount of 52,000 plus additional 1000. This results in 53,000. And the customer has offered to pay 24 per unit. This is the selling price, and this is the selling price for only 4200 units. And for our regular units, which is 15,300, the selling price will remain at 26. Now the first option is to reject the order from the new customer. So if we reject the order from the new customer, we will still operate at the previously given information. So we have the number of units to be 15,300, we have the contribution to be 8, and we have the fixed cost to be 52,000. So it's pretty easy to figure out our profit in this case. We can start with our total contribution. We have the number of units to be 15,300. We were given the contribution per unit to be 8. This gives our total contribution to be 122,400. And then we are also given the fixed cost to be 52,000. Now we can easily figure out the profit. That is just 122,400 minus 52,000, which results in 70,400. Now for option B, accept the order from the new customer, operate the factory at full capacity. So the full capacity was given to be 18,000, and reduce the number of units supplied to regular customers. Okay, so we have a total of 18,000 units, out of which 4,200 units will be for the new customer, and the remaining will go towards our regular customer. So that will be 18,000 minus 4,200, which results in 13,800. Previously, we were supplying 15,300 to our regular customers. Now we will only be supplying 13,800 as stated by our option to reduce the number of units supplied to regular customers. Okay, but remember, in this case, for 13,800 units, we have the contribution per unit to be 8, which was given in the question itself. But for 4,200 units, we have to figure out our new contribution, because the selling price is different in this case. So the selling price is 24 and the variable cost is 18.5, which gives the contribution per unit to be 5.5. All right, again, let's prepare a statement. We can start with total contribution. For the 4,200 units for our new customer, our contribution is 5.5, plus we still have our number of units towards our regular customers, that's 13,800. And for these units, the contribution per unit is still at 8. This gives the total contribution to be 133,500. Now we just need to subtract the fixed costs. And we have recalculated the fixed costs as well, because we had an additional 1,000 for our investment in new machinery. So the total is 53,000 in this case. Now we can easily figure out the profit. That is just going to be 133,500 minus 53,000, which results in 80,500. Alright, that's all for the fourth part of this question. Let's move towards the next one. We now need to advise the directors which option they should choose. We also need to justify our answer, considering both the financial as well as the non-financial factors. Okay, let's have a look above. We can see that profit is greater for option B, right? And the difference is 80,500 minus 70,400, which results in 10,000 and 100. So our profit for option B is greater than option A by 10,000 and 100. So profit for option A is greater than option B by 10,000 and 100. But we also know that there will be an additional increase in fixed cost for option B, and the fixed cost will remain the same for option A. We can write that down as well. No changes in fixed cost for option A, but it will be increased by 1,000 for option B. Okay, this is of 7 marks, so we need to write down at least 6 considerations. Now, we are also told that the order by the new customer, this customer is considering making a regular order for this quantity. So if we accept this order, which is under option B, and remember that our profit is greater for option B as compared to option A. So this increase in profit may be long term if this new customer makes regular order. Let's write it down. Increase in profit under option B may be long term if the customer makes regular order. Okay, and also remember that the selling price is different. The selling price for new customer is 24, whereas the selling price for previous customer is 26. So due to this reason, the regular customers may switch to competitors. Due to the reduced selling price for new customers, regular customers may switch to alternative suppliers. Also, we can write down that regular customers may expect to pay the same price as new customers. Regular customers may expect to pay the same price as the new customer. But if we consider option A, remember that we had been supplying to the regular customers with number of units 15,300, and if we consider option A, we can still supply those units, but if we consider option B, we can only supply 13,800 units. So under option A, regular customers will receive their usual order. Under option A, regular customers will receive their usual order. Okay, now considering these factors, we need to advise the directors which option they should choose. So I will go with option B, because remember that under option B, the factory will be operated at full capacity and we also have a higher profit. So the decision is that the directors should choose option B, since the factory will then operate at full capacity. Alright, that's all for the fifth part of this question. Let's move towards the sixth one. We need to explain two advantages to a business of using absorption costing. So the very first advantage to a business of using absorption costing is that it will be extremely useful for setting selling prices because it includes the element of fixed cost as the cost of a unit. Because we apportion everything to the overheads and then we calculate the overhead absorption rate from which we calculate the cost per unit. Let's write it down. Absorption costing is useful for setting selling prices as the cost of a unit includes an element of fixed costs. Alright, the second advantage of using absorption costing is that it avoids the separation of fixed cost and variable cost. And during marginal costing, remember that we separate our variable and fixed cost, which can lead to incorrect data or valuation. Let's write it down. Absorption costing avoids the separation of fixed costs and variable costs, which can lead to incorrect data when using marginal costing. Alright, that's all for the sixth part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.